take some of those savings, like these countries, and buy some gold, just like they're telling you what's coming. Maybe you should listen.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Hey there, my name is Shane Moran, and I'll be your host for this week's episode of Live from the Vault. So welcome to the show that goes beyond the headlines and uncovers the truth about the precious metals industry and the effects on the global economy in these historic times. You know, we have exclusive access to experts and insiders, and we reveal information and insights that you simply won't find anywhere else. Now, this week, we have the one and only Andrew Maguire, precious metals expert and whistleblower in the vault. And to help him pull back the curtain, we'll be joined by a returning guest and by popular demand by you, the Live from the Vault community. Yes, Craig Hemke is in the house. That's right. Craig Hemke of the TF Metals Report is in the vault, and you're not going to want to miss a word of this conversation. So just before we introduce our featured guest and head over to the UK, please help keep spreading the word about this channel by hitting that like button right now. Give us a like right now. It really helps the channel. And hit that share button. And also, if you haven't already done so, make sure you subscribe. And if you want to be notified in real time as each episode goes live, just click on that bell and we'll do exactly that. Now, for those who haven't already met Craig, he's very popular in the Live from the Vault community, of course. And but if you haven't met him, you know, he began his career back in the financial services industry in 1990 and retired in 2008 to focus on family and other entrepreneurial opportunities. But since 2010, he's been the editor and publisher of the TF Metals Report, found at tfmetalsreport.com. So go ahead and check that out. And what it is, it's an online community for precious metals investors. So, and with that, let's head over to the UK and talking gold with the one and only Andrew Maguire and our special guest, Mr. Craig Hemke. Over to you, Andy.
Well, I tell you what, there are times when I get really excited. Then I get really over the top excited. What we have here is an actual brother from another mother, but Craig, my friend, so good to have you on and join us today. And thank you so much for rising up to help us when poor old Shane, he's in hospital. And you know what? He got the questions and he said, I just can't, I'm in the actual hospital bed. Well, he sent me the picture of the hospital bed with his ventilator on. And there he is, gathering questions up for the episode. Look, and maybe thank you for stepping in and really taking those off him and helping us with those questions.
Oh, it's my pleasure, Andy. I've been friends with you and with Tom Coughlin for so long, and have always been such a big supporter of Kinesis and all your efforts to bring sound money to the world. So anytime I can do anything to help out, consider it done. I just think the world of you guys.
Craig, it's so wonderful. Well, look, I know we never have much time, so you're a busy guy. You've got an amazing site. You've got to keep everyone happy. I know you've got a lot of people that rely on your interpretation of what's going on. And by crikey, have we got some stuff going on? And, I just basically put up some charts on my episode showing exactly how these sell orders come in when after the fixes and 2:30 a.m. British time, how these raids come in. I mean, of course, what central bank in the world would actually dump 470 tons of gold onto the market, out of the blue, when we know every central bank bilaterally settles off the market, not to affect the price. So when we see, like we did on last Wednesday, just after, I think it was Thursday, after we topped out at the highs, what do we see? We wait for the fix to close. We wait for London to clear. Yep. Tell us what you saw, because I know what we saw.
To put a number to it, it was straight down at a 45-degree angle for 24 hours from 11 o'clock Eastern on Thursday to 11 o'clock Eastern on Friday. That 24-hour period, gold went down $70. Unrelenting. I mean, just one of these deals. And again, you can see that sometimes on the 1-minute charts. I mean, what you know is happening is there's just somebody just constantly on the offer, because otherwise there'd be at least some fluctuation, right? You'd be doing one of these deals that we see most of the time. And that's what we got last week. And you mentioned the control and the price management. We saw it in silver. Not so much this week, but the previous 2 weeks, we went a string of 7 out of 9 COMEX sessions, where if you pull up the hourly chart, there is a big, massive red candle, a red bar at either 10 o'clock Eastern, right after the London PM fix, or 11 o'clock Eastern. I mean, mind blowing. I mean, every single time, every 7 out of 9 days, just this big, massive red bar of COMEX selling. I don't, and Andy, this is nothing new. Most people, I'm sure, watching this understand that's how it works. The only other thing I would clarify is I still get people that go, well, how is gold manipulated if it's up, from $400 20 years ago? And the thing that I've always tried to remind people is the bullion banks make money, even when it's going up. They're managing their positions, right? You know this obviously, but they're constantly managing the ebb and the flow and trying to flow physical out of London to the price derived in New York and that sort of thing. They can make money just fine at a 10% gain every year. Where they get into trouble is, if it's a 30% gain or a 50% gain, that gets them really offsides, as you like to describe it. And I'll give you, and one more thing, you can see this in action. Think back to the end of November last year. Gold has been in a trading range for almost 3.5 years and breaks out on a Friday, Friday the 1st of December. And then 15 minutes into the Sunday trading on December the 3rd, it's allowed to go up $50 and then immediately smash down 100 to paint the chart. To me, as you've always said it, that was a sign that the banks were offside and wrong-footed and not ready for that breakout yet. It took 90 days before gold did finally break out on March the 1st. And I think that, and then went 20% higher. I think that's a little bit of what silver is doing now. After, again, 3.5, almost 4 years, silver contained below 28. It breaks out, but it now is going through its own 13, 14 week, little flag period as the banks are getting ready. And that's where you can see these interventions at 10 o'clock every day as they're trying to manage it and get themselves on the least painful side of the trade before it surges again. I think that's where we are at present.
Yeah, and we know, and we all know that the actual bullion banks are long silver, gold for their own book. And obviously they act as agent for the Fed, who use silver. We know that they've used it, and they openly, I think, use silver as you smack silver down to influence gold. And we see that time and time and time again. Now, the interesting thing is, and there's two things that come out of that for me, because everyone now knows the Fed's game. I mean, the Fed is the only central bank short gold globally. So everyone knows that game. And so because of the massive OCC derivative bets in the billions and the similar COMEX bets, derivative bets, options bets, of course, against silver and gold, because they are so large, they're literally forced. They're forced to mark to market. And if we look at February, March, April, May, June, and now July, each higher stair step is an actual options expiry point where they are forced to do it. Now, if you're a central bank or a sovereign or an institutional, then you say, well, look, they're going to bring this price to me, so I'll just let them bring it to me. But to be honest, they don't care about gold sub 3,000. I mean, $3,000 gold is like anything below that's good value. So, and if not higher. So I think what it does, I guess the point I'm trying to make is that it shows a weak hand. The Fed, when they put, literally, you just talked about what started that 45-degree angle was suddenly 450 tons of paper gold sold at market, bang. Now, nobody in their right mind would do that to get the best price. So clearly, if you're a trader, or we are a trader, you'd have exceeded position limits to do that. CFTC would be all over you. You'd be hauled up. You'd be fined. They would clearly. Now, if you're the Fed, you don't get any. You've got a free pass. So, but the thing is, I guess what I'm trying to say is, this is a weak hand, and everyone's learned their stupid game, and they just do it time after time. But how long do you think they can keep this up?
Well, it becomes a function of physical. It's like the video that we recorded. What is that, Andy? 2 or 3 years from now,
That was great.
all the fake digital alchemized metal that is treated as good as the same, good as gold, and the unallocated accounts, the ETFs and the like.
Yeah.
As long as there is a perception that there's sufficient metal to be delivered at whatever price is derived through all the derivative trading, then the market continues to function. It's when you get a bank run, when people go, wait a second, I sound like you. Wait a second, hold on just a minute. I didn't do my best accent there, Andy, but that's an Andyism. I'm not waiting 60 days for my metal. It says right here, and so until there's that sort of fractional reserve system breakdown and demand for immediate delivery, then the system continues. And that's why, again, I see even people on my site, but I see people on Twitter or other analysts say, oh yeah, the next stop for silver is 48, or the next stop for gold is 3,000. And I'm like, it has not been my experience in 15 years of doing this that's how these markets operate. They go up. In bull markets, they make a series of higher highs and higher lows where price takes 2 steps forward and then 1 step back. All the spec money rushes in. You reach a crescendo like we reached last week with some of the largest speculator and hedge fund positions that we've seen in years. And then all of a sudden, everybody that's bought has bought. The momentum kind of tips over. The banks and the Fed kind of help it along. And all of a sudden, you get this correction where the money rushes back out. And then we're washed and we're rinsed and we're ready to start the next move higher. And I think that's where we're getting to. August is seasonally about the second best month of the year. It doesn't mean we go up every August, but if you average out all the gains from August over the last 25 years, it's second only to January. And then you throw on some of the macro stuff, like, even this week we've seen Bill Dudley come out, former head of the New York Fed, say, the Fed should cut now, not wait. Powell's leaning that direction. The U.S. economy is clearly slowing and rolling over. So if we get into August and we either get a surprise rate cut, which I'm really not expecting next week from the Fed, but as we get into August and we get to the Jackson hole down, as I call it, where everybody was focusing on all the central bank ministers that'll show up in Jackson Hole, Wyoming for their annual meeting in late August. And then we'll start looking at the September FOMC and a whole extra month of bad data. That's where you can start to see the seasonal effect be backed by kind of some fundamental stuff too. So whether it'll be enough to finally bust us out, we were sure close last week. But it might. And the next target is, probably more like 2650 on gold and 34, 35 in silver. And I think, as we make the next move up, I think we'd all probably take that and then see where we go from there.
Yeah, and I think that what's interesting really, and this to put context into silver. Now, since Basel III NSFR conditions kicked in on the 1st of January, it's taken a while, but essentially now, because the physical markets in the UK that are physically deliverable, and we do see the short positions. Short positions on the COMEX really are largely hedging position, and obviously we know that it's position concentration. So you can still play the game with position concentration, but step by step, gold has risen because ultimately it's physically backed. Now, silver, on the other hand, is not NSFR compliant, and what is so interesting is that we've got my Indian connection, and they have been very, very busy buyers through this entire sell-off. And what it is that but they can't. You can't you can't take an ETF in silver. You can in gold. So in gold, you take an ETF, you transfer it across to London, it becomes physically deliverable, and you have to T+1 it. You have to stump up that physical. Silver is not NSFR compliant. So what they're doing is literally buying the silver. There's no point in ETFing. It becomes an unallocated account, which then gets salted amongst the bullion banks. But they're going directly to the COMEX, and they're going to the back door, and they're taking it out, because where else can I have got silver at $29 this week? Where else other than to go to the COMEX and say, give it to me, baby, because I can't get it anywhere else.
And that's an astute bit of analysis right there, my friend. It is we were in 700 million ounce supply deficit, excuse me, over the last 4 years.
Yeah.
At present, and again, this is just where we are right this moment. The silver price is actually seeming to be hindered a little bit by what's going on in copper. Gold took off, broke out in March, 1st of March, and then rallied all the way to the middle of April, almost 15%. But for most of March, people on my side were pulling their hair out. Why isn't silver going up? And often silver going up is the key to getting the mining shares to go up too. And so everybody was going crazy. Well, and I kept thinking, well, let's just wait and see if copper eventually breaks higher because the fundamentals for copper are so strong. And suddenly copper takes off and silver goes with it. And they both peaked out right around the 17th or the 20th of May. Copper traded at over $11,000 a ton in London, and I think it hit $5.17 a pound in New York. Well, this week, just 2 months later, it's like $4.17 a pound. It's down nearly 20%. Well, so I think there's part of the reason silver is struggling here, at least just even getting some of these hedge funds to buy it, is I would encourage people to, I'm sitting here holding this pen and playing with it. Maybe this would be a good example. Think of gold on one side and copper on the other, and silver kind of the hinge in the middle. And if they can all go up at the same time, that's great. What's currently been happening is gold's been going up and copper's been going down, and silver in the hinge in the middle is kind of stuck. And fundamentally, you could make that case too. You could say, well, gold's a monetary metal and copper is a fully industrial metal, and silver's kind of a combination of both. I guess most people look at it industrial, but you and I and everybody watching us thinks it is monetary and as an investment too. So it's kind of hinging at this point. Copper's been down. Geez, Andy, as we record this is the 8th day in a row copper's been down. That's the longest losing streak since January of 2020. It probably won't keep going down for 28 days. So at some point it's going to stabilize and turn higher, and that'll help silver to rebound too. But for now, till we can kind of get, this kind of rising tide to lift them all, that seems to be impacting at least the derivative price of silver. I'm sure you track Chinese demand very closely, Indian demand very closely. And one last point I wanted to make sure I mentioned, that you've probably covered this earlier, I don't know, but the news earlier this week that import duties on gold and silver were being trimmed in India is not something anybody should overlook. They went from 15% down to 6%.
Yeah.
And really just in time for wedding season. And the history in India is if gold is deemed to be expensive, whatever that is, the massive demand shifts to silver. So you're cutting import tariffs or import, whatever you want to call it, taxes, VATs, whatever. And then at the same time, increasing potential demand fundamentally. We could be entering a very strong period for silver too, but we got to get that copper price to head up. That'll certainly help.
Yeah, and I think you mentioned India. And of course, the other thing is they repatriated 100 tons of gold from the Bank of England. And our information is they're now going to repatriate every single ounce of gold, onshore it. But here's the problem. Some of it sits at the Federal Reserve. What do you think their chances are of getting their gold back in a hurry from the Federal Reserve, which we know what happened when Germany tried to get their 300 tons back? It was going to be 7 years initially before they were embarrassed into and then some of that bullion was melt gold. It
Yeah,
had to be
melt gold. Yeah, it's like, wait a second, where'd this come from? And for people that don't know, melted bars are primarily from the U.S. Confiscation of metal back in the 30s, where they just took it all and they're about, what are they, 90% gold or something like that. They're not the current standard of 4.9s. And it's just coin melt. They melt them all down and put them into bars and put them in Fort Knox. And Germany's like, this isn't hard. Why are you sending us this? So we'll see about India. In a bigger picture, why would they want to repatriate some of their gold? Why would Germany? And I look, I don't know. A lot of folks want to, claim they know the timing of, this alternative that will eventually be offered to the US dollar for use in global trade, particularly amongst, I guess what we would call potentially adversarial nations of the US, Russia, China, throw India in the group. And to give that type of competing currency some kind of advantage to level the playing field, well, it's going to be backed by something. A lot of people assume it's going to be commodity backed or gold backed or partially gold backed or whatever. So if you're India and you can see that writing on the wall, again, not saying it's 5 weeks or 5 months or maybe even 5 years from now, but if you can see the writing on the wall that that's eventually where this is headed, well, you damn sure you'd want your gold in your own vaults too. You wouldn't want to be taking any chances, knowing how the game is run in London. So again, I'd say that's also another sign that eventuality is coming. This alternative to the U.S. dollar, and I would just add to that, a lot of people, at least in other interviews I've done, and sometimes I'll see this at TF Metals Report. People think that that's some kind of binary thing, that one day the dollar is the reserve currency and there's all this demand for it. And then one day it's not. No, it won't work like that. This new currency will just simply siphon away some of the demand for dollars. And I think most people understand the kind of laws of supply and demand. If you are increasing the supply of any good while at the same time decreasing the demand of that good, the price, the value falls. I mean, that's, the two curves that most everybody, maybe learned in economics class. Well, what would happen if some of that demand for dollars gets siphoned away at the same time as the supply of dollars is increasing by a couple $1 trillion every year? Lower demand, lower value, lower price for the dollar, which then, again, the converse of that is a higher gold price. So again, that's where I guess I'm kind of connecting random dots off of your question, Andy, but a couple of points that I thought we probably should touch upon.
No, very, very relevant. And especially, I think this de-dollarization process, it's obviously very helpful if you are going to move over to another form of settlement, say, of oil and energy, which is a multi-trillion-dollar marketplace. And considering that the BRICS members between them and all the upcoming members, they either consume or create 85% of that. So why the hell would you use the US dollar? And especially as what we see now, and this is what we're seeing a pivot. They know they've lost the war in Ukraine. Not that you would hear it from the mainstream media, but you know that the pivot is now going to China.
Yeah.
Because that is the worry for the US, the unipolar hegemonic power. Because between Russia and China being the kingpin here, then you've got a multipolar powerhouse, which, and even this, and we've got evidence now, or we've heard information that the BRICS are going to form their own parliament, that this is turning into a real, a shit show for the dollar, because why? And especially, and the other thing is then if you are pivoting over to China and you've already got sanctions galore against Russia, and now you've got increasing sanctions against China. If you're India, for example, and you are now dealing with Russia and China, which they are, don't you think sanctions are coming their way too? So there comes a point where you just simply need to get your gold back, de-dollarize as quick as possible, because you know it's coming. It's weaponized. We've seen it weaponized, and they're going to re-weaponize.
No doubt. Andy, I saw 2 weeks ago, after the ECB and the EU and the US rolled out their plans, are going to start stealing Russia's assets that they froze back at the beginning of the Ukraine war. Now their plans to start stealing Chinese assets because they're supporting Russia.
Yeah.
I mean, wait a minute. Hold on just a second. There's a Andy line for you. Anyway, anybody could see this coming, and you might not. If you're India, you might, to your point, right now, not see, you can see where your interests maybe are aligned with the U.S. in some regards, but you can certainly see where if at some point your own national interest goes against what the U.S. perceives to be their own national interest, you've got to sit back and go, well, it's just a matter of time before they do that to us. And so these people that, and we've been talking about this for 10 or 15 years. There's so many people out there that exist in the fiat world, that the only world they've ever known is the U.S. with this, this transitory title of dollar reserve currency and all of the benefits that have come with that. And they think that that's always going to be that way because that's the way it was yesterday. It's not always going to be that way. The countries are preparing for their future as well. And so this is all part of what augurs for the gradual, steady accumulation of gold and silver, physical gold, physical silver, because they have always been and will always be your lifeboat in that storm of economic instability, moving from one monetary system to another. That's always been the role of gold and silver, is to get you across the sea into safe harbor. And if you can't, really, seriously, the signs are all there. Anybody that wakes up, at some point in the future and goes, God, I don't know how I didn't see this coming. Well, you just weren't paying attention. And so that's why, we can, and I feel this way too a lot of times. I complain, every time I see the blatant manipulation, because you can see it on almost a daily basis. It's so frustrating. But at the same time, if I can still go online and buy myself an ounce of gold for $2,400 or an ounce of silver at $29 or $30.
Mm.
Thank you. I thank you. I appreciate that, powers that be. Can I have some more, please? Because we're being blessed with more time to accumulate and prepare for what is an economic, monetary certainty.
And this is one of the good things about your site, Craig, is that you are providing information for people to make up their own minds. But it's all about, to me, bottom line is we all need to take personal responsibility for ourselves. And what a site like yours does is you attract the kind of people that are looking for information to make their own minds up. You're not telling people to buy and sell. What you're doing is giving information. And I think this is so critical, that there is services like yourself, like you provide, where people can actually come, because you're not going to get this on the mainstream media. You're not going to get it off Bloomberg. You're not going to get it off anyone. There's only one narrative: US dollar, US dollar, US dollar. And what I think is interesting is you've got your Fed prints $1 trillion every 100 days. There has to be a point, Craig. There has to be a point. You have to give your head a shake. There has to be a point where somebody says, I ain't buying that anymore.
Right.
And if enough of them do that, rates would go up to 15% overnight.
Right.
What would that do to the $2 quadrillion derivative swamp?
Correct. And again, this is that mathematical certainty. Neither you nor I can know, at what point it breaks. I might have thought maybe $20 trillion is all that we can handle, 30, now we're up to 35 trillion in debt. This fiscal year for the U.S. government, which ends at the end of September, is going to set a new record, something like $1.1 trillion spent simply servicing the accumulated debt. We are headed into recession, which means tax receipts are going to fall while spending is going to increase. And so this $2 trillion in new debt that we added this year is going to be $3 trillion next, if not more. So we're in this kind of exponential phase now, when you have to you just can't keep up in terms of servicing that debt, and it spirals out of control. Now, that doesn't mean the whole system's going to collapse. I think for precious metals investors, the next thing they'll have to watch for in the next probably year, two, is the U.S. will head down the path of yield curve control that Japan has been on now for a couple of decades, because there's really no other option. As you mentioned, investors, central banks, hedge funds around the world will go, hey, wait a second, I'm not funding this Ponzi scheme anymore. Well, somebody has to. Where's the money going to come from? And the Fed will simply say, look, we are the buyer. Come to us. We'll be the buyer at anything over 3% on a 10-year treasury. We'll be the buyer. And there'll be this floor, yield curve control. And that's when that if anybody is not a big holder of gold and they're waiting for, what's the sign? What will I be waiting for this big blast off when the things really get out of control? When the Fed institutes yield curve control, which they will, and they're by the very almost definition, they're institutionalizing negative real interest rates by artificially holding nominal rates lower than what the inflation rate will be. That's when, if it hasn't exploded by then, that's when, and this is, again, we're not like we're splitting atoms here, Andy. This is just math, man. It's not more complicated than that. As the U.S. gets deeper into debt and as interest rates rise, that amount that's needed just simply to service that debt, like I said, it's already 1.1 trillion, go to 1.5, it'll be approaching 2. And we talk about unsustainable. That's a definition of unsustainable. And all of this is coming. And so that's why my site was founded on this notion that we're living at the end of the great Keynesian experiment, Keynes being the economist from the 30s and the 40s that kind of dreamed up this debt-based monetary system idea. And it was always going to turn out this way. All attempts in the past to run this type of system have turned out this way. We just don't know, again, how long the plates can continue to be spun. But that moment is coming. And again, I just beg people all the time, own some physical gold. It's really your only way to be sure that you're protected. There will be you're familiar with the crack up boom idea, that Austrian economic idea, that everything goes up because they're printing money so fast, kind of like, the Weimar Republic and when money dies and all that kind of stuff. Who knows what will perform, great as all this is ending. But what we do know will perform for sure is gold and silver. And if you throw in all the derivatives, the alchemy that's been done over the years to try to convince people that, this is as good as gold, that's as good as gold, the unwind of that system, throw that on top of everything else. And let's just say, again, we should be grateful that the powers that be continue to restrain price for their own selfish, management of their books. But if that means you can go online, or if you can go to Kinesis and acquire an ounce of gold for $2,450 at a time like this, that's a pretty good deal.
Yeah, Craig. This is absolutely correct advice. And the thing is, we're not saying invest in the futures markets. We're talking about physical gold, physical silver, and it'd be interesting to see what kind of a balance you would see personally. Obviously not giving trading advice, but essentially, personally, where do you see? Obviously, gold, of course, we know that. Silver might be easier to transact with as a barter tool. What do you think?
Yeah, that's always been kind of I don't want to call it a Mad Max scenario, but that's always been something that's in the back of people's mind, that you own physical gold to protect your net worth, you own physical silver to protect your ability to buy things on a daily basis. And I guess that's true. We just saw a massive computer crash last week. What if there's something that takes down the entire computer system and you still got to buy some food? You'll be darn glad you've got some physical silver, because what are you going to do? It's hard to punch off a little itty bitty. Gold's just not fungible in that way. I personally own more physical gold than I own physical silver, and always have. And I've always been more a proponent of physical gold, just because that silver market is so corrupt, Andy, that, it just disheartens you in so many ways because of the pricing scheme and the management of the scheme by the banks is so corrupt. But at the same time, there's a lot of people that own it because it's so corrupt. Because it's so highly leveraged, 100 to 1, or God knows what it is now, that there's 100 claims for every 1 ounce. That when you finally do get to some actual fair price of how many, fiat currency units does it take to get that ounce, then it's multiples higher than, 30. So there's a lot of people that own it, for that type of gain as well. But again, my concern has always been this monetary debt-based system transition. I don't want to say collapse, but transition. And how do I harbor myself through that? And that's where, again, you can't, a lot of things will go up in value, I'm sure land and, other hard assets, but I don't know how much, but I do know gold's going up, and that's why I just keep buying it. I just bought 2 more ounces. We're recording this, the cat out of the bag on the 24th. I just bought 2 more ounces today. So I just think the steady accumulation is the best way to go about protecting yourself from all of this madness that one day is surely going to come to an end.
Well, I think that window is definitely closing, because, as we know, the physical markets are now settled outside the LBMA, CME ring fence, and they can raise up to 600,000. Lots of open interest, and very well that momentum trade. I mean, even Bloomberg acknowledges that the oil trade, the gold trade are very similar. You've got the momentum traders, the CTAs control 75, maybe 80% of all the trade. So they don't like sideways. They either want down or they want up. And of course, when they go up, they get rinsed out. When they go down, guess who's on the long side of that? So we know the game. But I think as more and more of the physical settlements physical settlements are happening outside of this siloed casino world, then it's going to, the COMEX is going to have to reflect a physical price.
Yeah.
Or what we're seeing in silver. Now, you don't have to do it in gold. You can simply EFP into a T+1 deliverable contract, hence gold rising. Silver is left lagging because it's still got the legacy of what gold used to have, is that anything that you put into the spot market in London isn't deliverable. So
right.
as you say, so I think that means that the crosshairs are on the COMEX, and I think that's something they must be worried about, because there's arbitrage, the big arbitrage differences between the global physical markets. We know all our silver buyers. We were acting on behalf of silver buyers this week. The minute they said anything sub 29, how much can you get us? There it is. These fools, these absolute fools, they don't realize that what they're doing is actually ultimately shooting themselves in the foot, because as the gold price continues to rise, which they cannot stop, then obviously you can't have the ratio trade ballooning up to 100 to 1 again. It's
right.
Ludicrous. Even nobody in their right mind can assimilate that in a logical mind. It doesn't make any sense. And there comes a point, I don't know where you think that is, Craig, but it's interesting that there comes a point where you break through a certain level, bang, done. You're back up to the highs. Where do you think that might be? I mean, you've probably got a lot of feedback from people on your site.
It's going to move up in stages. The good thing about ranges like we're currently in is the longer you're in one, more people see it. So you risk the risk of a breakdown, and get some sell stops. But you also run the risk of a breakout. And that's exactly what gold did in March. Everybody saw it. Friday, the 1st of March, price went up $100 the next week, and then another $250 the next 5 weeks. It took 13 weeks for gold to kind of flag sideways from the 1st of December to the 1st of March. Gold or silver finally broke out above 29 back in the middle of May. Okay, it's been about 9 weeks, maybe 10, that it's flagging sideways. So I would say the next move is for silvers to break out. get above 33, get another rush, about 10% higher, and then we flag again, or the banks try to get on the right side of the trade, set their books right again. Then from there, it becomes, you can just look at the chart and go, okay, well, 44, 42, and then higher from there. It's harder to do with gold because gold's at a place it's never been before, right? You can't look back and go, well, 2 years ago, gold, found resistance at 2750. It's never been to, these levels before. So that's a little harder to decipher what the next steps would be. But I just always want to encourage people to not, you don't buy the stuff or trade the stuff hoping that, you're going to get this moonshot, because I, hear that term all the time. As long as the system persists, and it won't go on forever, a physical demand will break it. As long as the system persists, it's always going to do, you call it the wash and rinse cycle. It's always going to do this 2 steps forward, 1 step back. And if you use that to your advantage, you maybe sell a little bit of your trading position when things look the best and buy a little when things look the worst, you're going to do okay. All the while accumulating physical in the dips. I can't emphasize that enough.
And I never want to go through a single night having sold any of my physical. Because I never know what I'm going to wake up to. Yeah. You just don't know.
I know the feeling.
Yeah. Ever. And I think I know that you're really pushed for time today, Craig, but just one last thing. You must have seen the zero hedge thing on, it was HeartNet, but Bank of America HeartNet. Now, what was mind-boggling, not that he was making the revelation that central banks are buying gold at any price, but I think what was really, really interesting was he's now saying that he talked about the breakdown of the bond to gold correlations, which I know you've been talking about. We've been talking about it. It's definitely happening. And people are saying, hey, how come gold's rising and it's not doing what it should be doing? Because what he's suggesting is, and it's good that a first tier analyst is out there talking about it on the mainstream, is that he's basically acknowledging that really what happened after when gold became NSFR compliant in January, what it's now started to do, it's now actually dictating the price of a bond, not the other way around. And so I think this, as people become aware of this, hang on, maybe my old trading algorithms are misplaced. How come they're not working for me? Because I used to do one because the other did the other, or the dollar rose, I'd sell gold. But hang on, it's just disconnected.
Yeah.
So it's interesting because this is, to me, because US treasuries, when they are clearly being swapped for gold in large enough size to create this divergence, then what we're heading for is the de-dollarization and revaluation process to come to an inflection point.
Andy, I think you've connected all the dots. And again, it means people listening to us, they can do it through Kinesis, which, as you know, I've been a supporter. What, 2017? When did we? I mean, it was something like that, wasn't it? It's been how many years? 6 or 7 now.
Yeah.
Just get yourself. Let's put it this way: if these central banks are, their treasury reserves are their dollar reserves, right? From international trade, they use a dollar, they get a whole bunch of dollars in their foreign currency reserves, and they buy treasuries, right? That's how the system works. Well, if they're taking some of their savings and buying gold with it, which is basically what they're doing, their dollar savings, then why in the heck wouldn't people like you and me and everybody watching do the same thing? Take some of your savings. They're not going to take all your savings. They're not dumping all their treasuries yet. But take some of your dollar savings, some of your euro savings, some of your pound savings, whatever. You get paid for your work in pounds, and you save what you haven't spent. Take some of those savings, like these countries, and buy some gold, just like they're telling you what's coming. Maybe you should listen.
Well, Craig, I know you're time sensitive today. So I really do thank you for coming and sharing just a fraction of the kind of stuff you guys talk about every single day. I know that even you were on holiday, you didn't stop working. I know you people need information, and I know, and you feel kind of responsible for it. So I'm sure that the missus was not 100% happy about you working so hard, because mine wouldn't be. And but I say thank you for all you do and the responsibility you take upon yourself to actually help people. People look to you for help. So thank you for all you do too.
Thank you. Well, Andy, it's kind of you to say. And you know, as I do, you can't really take a day off when you are the sole chief cook and bottle washer, as they say. But it's a mission. It's a mission for you since 2008 or 9 or 7, whenever all that, started with you. And it has been a mission for me since 2010. And I don't know, God has given us this platform. And so we have to use it as responsibly as we can to try to warn as many people as possible for what we are quite certain is coming. So I do some analysis every day at my site, some analysis in the morning, a podcast in the afternoon. In between, the members of the site add all sorts of information. They're all scouring the internet for links and posts and things, that kind of add color to the background. And so for $15 a month, I think it's a bargain. So I encourage everybody to, check us out. But I encourage everybody to check out Kinesis as well. It's just a great platform. So thank you for all you do and all Kinesis does. And anytime you want to have me back, you just let me know. We'll, you and I, Andy, they'd plug we didn't even have a cocktail in front of. Can you imagine if we did this late enough in the day where I was, knocking back a little something and so are you? We'd really
like
get
we
out.
did in London, you mean?
Right. That's not a bad idea. I'll let you know.
Not a bad idea at all. But we're coming for a visit. But also in the meantime, before I come for a physical visit, I'll come and join you for a bit of a catch up. We have fun. It's always so laid back and just we don't know where we're going to go. We haven't been banned yet. So one way or the other, it'll be fun.
We'll do
Thank you for joining us. And I definitely promise you a visit too.
All right. Thank you, Andrew and Craig Hemke, for another, of course, fascinating discussion. And remember, to our viewers here, only buy physical. Make sure it's backed 1-to-1 and understand the difference between what Andy affectionately calls the casino paper gold and silver markets and the actual physical gold and silver markets. They're not the same. So don't be fooled. And there you have it. That's all we have for you today on another episode of Live from the Vault. And remember, please keep spreading the word about this channel and hit that like button. If you haven't already done so, hit it right now. Share this information and make sure you subscribe. And if you want to be notified in real time as each episode goes live, just click on that little bell right there and we'll notify you as each episode goes live. And with that, we'll see you right here next time on Live from the Vault. See you then.